Good afternoon. This is the second episode of Mod Bless America. We have Sam from the Land of Ginger, the famous and fearless research assistant, producer, and all things Mod Bless America extraordinaire. Sure glad to have you here. Sam, how are you doing today? Good
Doing
afternoon.
good. Good afternoon. So today I'm gonna open up by saying to like and subscribe to our channel on YouTube. It's just under Mod Bless America, and then also leave a comment. Make sure to like and subscribe. All of those will help us a ton. And then also follow us on Instagram, TikTok, Twitter. We got Facebook coming up, and then we'll also have Apple Podcasts, all under Mod Bless America.
Thanks, Sam. So we got a little bit to talk about. We have a guest today. Excited
Good.
about that. Our first ever guest, the inaugural guest, Jason Peters. Come on up. Or the immortal words of Bob Barker and The Price is Right. Come on down. Jason Peters, welcome, buddy. Glad to have you here. Thanks.
Glad to be here.
So I've known Jason a long time. He is truly one of my best friends, but he's also a great banker. And with that, Jason, give us a little bit of your background, your history. Tell you what, he is the pride of all Hayes Center, Nebraska.
Hay Spring.
Whatever. Hayes Springs. Hayes Springs Eternal.
Uh, Again, I'm Jason Peters. I've been in the financial industry, primarily banking, since 1996 when I interned in college with NBC Bank. I was with NBC Bank through 2001. In 2001, I'm in October of 2001. I moved over to Security First Bank.
Was it called Security First at the time?
Mm-hmm. It was.
How big was it at that time?
Security First Bank, we were about 230 million in assets, give or take a little bit, but I think that's where we were. And by the time I left there in May of 2019, we were just shy of, I think we're just over $1 billion at that point in time.
Wow. So you increased it fourfold in 15 years.
Yes, our bank grew about 4 or 5-fold since.
Wow.
Since
That's awesome. That's big growth.
Yep, since we started there in 01. And then in 2001, certain someone sitting here with me today.
2021.
Or yeah, that's what I meant. May of 2019, I moved over to Citibank. Somebody sitting here today recruited me over there.
Sam,
Oh yeah.
look at you.
And another gentleman by the name of Aaron Bell, who I've worked with since 2001. We've kind of partnered together, and we're now in December 23. Aaron and I made the switch over to I3 Bank. I3 Bank's formerly known as Bank of Bennington. It's out of Bennington, Nebraska.
And you have a branch here in Lincoln.
And we have a branch.
You guys are still there, both you and Aaron.
Yep. We've been there. Yeah, we've been there since December of 2023.
So I3 is a community bank. You deal consequently with lots of people in the community.
Primarily in the business and commercial world, yes. Commercial real estate world, yes.
So that's the bulk of what I3 does, or what you and Aaron do, is commercial lending. Is that C&I, commercial and industrial?
Mm-hmm. Yep, that is correct. And we do a lot of commercial real estate. There's a lot of commercial real estate in Lincoln, Nebraska. We don't have a lot of industrial type businesses here in town, so it's we just do a lot of commercial real estate.
So when you're doing all of that underwriting, what do you hear from people being the biggest cause for backing away from a deal? Is it, I mean, obviously everybody negotiates a price. They wouldn't get into the deal if they didn't agree on the price. So is it interest rates? Is it some of the criteria for your underwriting? What do you think the biggest objection people have to going forward on a deal, besides a problem turning up in an inspection of their property?
Interest rate is always one of the biggest factors, but it's all about the price they can get it for at the cost of borrowing funds, to the real estate taxes, to the insurance that they have on it. That's the bulk of your expenses that you'd have going into a commercial real estate deal.
Interest rate, taxes, and insurance. Those are the big three.
Big three, and then you get your other utilities and maintenance of the real estate or whatever you're purchasing. But the biggest items are always going, or the biggest factors are always going to be interest rate taxes, real estate taxes. As you know,
So
the
what
state taxes in the city of Lincoln are a big deal.
state of Nebraska?
In the state of Nebraska, yeah.
So what when you quote somebody an interest rate, what is included in the calculation of that rate? Take the competitive market off the table. Every bank goes through a process. They basically say, what's our cost of capital? What's a reasonable return? And what risk premium do we put on there for someone? Let's say Sam does it and he flames out and can't make his loan payment. So you've got credit risk. Is that really it? Or are there some other elements before you get into the competitive market that drive your calculation of what you're going to charge me or Sam or anybody coming to you for a loan, what that interest rate will be?
Well, to be honest with you, the biggest thing that in our market we have to deal with, unfortunately, is the competitive rate side of it. Because Lincoln's overbanked. We got a lot of banks in this town, and we got frankly, a lot of really good bankers in this town or in our market, I should say. And so we got to maintain competitiveness regardless of where we sit as a bank as a whole. Well, if it doesn't fit where we need to be cost of funds wise at the time, or where the rate is versus our cost of funds at the time, we just have to pass on the deal.
What's cost of funds?
It's the total cost that the bank has, which would include your interest on your deposits.
So if I make a deposit, you mean what you pay me in interest for having the use of my funds?
Right. If you have an interest-bearing account, or our cost of funds, we're borrowing from the Federal Reserve Bank.
Do you do that often?
A fair amount. I mean, all banks do a fair amount. It all depends upon where you're sitting at the time from a liquidity standpoint on your core deposits. Core deposits don't cost a bank a lot. Core deposits are your general checking and savings account, come with an interest rate, but it's a lower interest rate. But
so CDs, passbook savings,
right. Those
other financial instruments where you're paying somebody to use their money.
Right. Where it's a little more costly from that standpoint. And then of course we got our overhead and where we're sitting at the time on our overhead. And just those factors play into what our cost of funds are.
Which then turns around, every other bank has a cost of funds. And everybody is pricing. So a high quality deal, everybody wants to offer a lower rate in hopes of landing that deal in theory, but there is some tacit floor to an interest rate, correct?
Correct.
Do you get people shopping you for that, trying to get to that floor rate?
Sure. On just about every deal, somebody's shopping around, finding out where they can get the lowest rate. So there is still some loyalty with customers that, if they know that you're going to back them at any point in time, because businesses go through cycles, people go through cycles in their lives. And if they know that you're going to stand behind them, they're going to primarily try to stick with you because you've backed them before. So we'll hold on to those clients.
So generally you're going to give the most favorable rate to a long-term loyal customer that you have some level of confidence isn't out there shopping you, meaning making you compete against all these other Hunyak banks.
That is correct.
So in one takeaway, you may not be best served going and shopping every single deal with every freaking bank in town.
It definitely helps in the long run.
Interesting. So before I let you go down that path, let's come back to it. Sam was doing a little bit of work for us because you are the fearless research assistant. And one question I want to have answered is, when somebody's coming to you, what's typically their household net worth? Or if they give you a statement of a financial net worth, they give you a balance sheet, a personal financial statement, they're all the same thing. They have the assets, everything they own. If they sold it and got that much, they pay off all of their debts or liabilities, and what they have left over is their net equity or their net worth. What's the average net worth do you think that you guys consistently see?
Now,
and by the way, Let me help define it. Net worth, assets minus liabilities, equals net equity or net worth. Ignore the Fed and Dodd-Frank saying you can't count the value of your home.
Sure.
Add in the net equity in the home, just a standard personal financial statement before you start monkeying around or having a regulator change it. What's the average net worth of somebody coming in to see you guys?
So since we primarily deal in the business, we primarily deal with business people or commercial real estate owners within our market. Those are going to be probably a little higher net worth individuals. And so for the average that we see and that we're dealing with on a daily and monthly basis and annual basis, I would say that our average client probably has somewhere between 700,000 and $1 million net worth. Now, that's going to be different. That's going to be different than the average person that's out there in the banking community that's doing more consumer type banking and that kind of thing. I would tell you that probably if you're overall the clients that would come into a bank, like say a larger bank, you're probably your average net worth, and it's going to vary by age group.
Absolutely.
So you're 20 to 30 or 30 to 40, and those have been in the working environment for a sustained period of time. I would say that the average 40 to 50-year-old probably in today's world has a net worth of somewhere around $300,000 is what I would say. It's going to be pretty shockingly low.
That is shocking. Sam, what do we have? If you want to be in the top 5% of net worth, according to Forbes and the Federal Reserve, and I think the census, maybe there were a couple of different sources. What was that number?
So to be in the top 5% for the average net worth for a household is between $1.17 million and $3.8 million.
So top 5% of net worth, as we defined it, 1.2 to 3.7 million, somewhere in that range. And again, that'll vary by age. It'll probably also vary by geography.
That's an overall.
It's overarching. We're not talking Nebraska. It's a national average.
Well, nor is it talking age group.
No age group.
No age group, just simple.
I'd be interested to see what that looked like from an age group breakdown.
Yeah.
Using that same criterion, only going from 30 to 40, 40 to 50, 50 to 60. That'd be very.
What's the top 2%?
2% is $2.7 million.
Top 2% of net worth is 2.7, is basically greater than 2.7. So the top 1% is 13 and change.
The top 1%?
Yes.
Top 1% is 11.6 to 3.7 million.
3.7. You went backwards, dude.
The 1%?
Yeah,
Oh, well, did I say 3.6?
you did.
7.6 to 13.7.
You do it in the land of ginger there. Well, anyway, so 11 to 13 million, roughly, to be the top 1%. So do you remember back, what was that, 2016, that roughly you had all those guys out protesting and saying the 1% is, illegal and they're too much income disparity in net worth?
Yeah.
Wasn't that 2016?
I don't remember. I remember it, but I don't remember the exact year.
I don't either. I just remember they were taking over parks and doing all this stuff and protesting against the 1%.
Yeah.
So 1%, assuming the United States has a population of 350 million, that's 3.5 million people have net worth in excess of, what'd you say, Sam, 13 million?
Yeah.
13.5 million. That doesn't seem like that many people to me.
That's not that many.
And then you said roughly 300 to 700,000. Although you said one's coming in for C&I or 700,000 to $1 million, but the bank at large is lower.
Yeah, we're probably dealing with, we're dealing with the higher net worth demographic in our line of work.
Commercial.
Right. And so we're going to see a little bit of a
little bit higher.
Yes, we're going to see a little bit.
Still, that's shockingly low. So what would you loan someone that has net worth of, say, $700,000? What sort of a loan, generally speaking? I know it is derived from income. What would they qualify for? Can you give a number based purely on net worth?
Some financial institutions will loan up to, you mean on an unsecured basis?
Well, if you're doing commercial, meaning commercial real estate, you'd securitize against the real estate. So that's not unsecured.
Right. but just to say that somebody, what would we loan somebody that has a $700,000 net worth? Uh, it depends upon the project that they're involved in and stuff. Net worth wouldn't have necessarily all the factor to do with what we're going to do on the loan. Probably a better way to put it is, what would we lend somebody, or what would a financial institution in general lend to somebody on an unsecured basis based on their net worth? It's somewhere between 7 and 10% we can lend to somebody on
So $700,000, you'd lend somewhere between 50
and
and
$70,000 on a line of credit unsecured.
line of credit.
We could, but
Up to that amount,
Up to
but
that.
obviously income.
that's kind of a generalization in the financial world, I would say,
Okay.
that happens when we look at net worth. Net worth is one factor we look at, but we're going to look at the project itself first and how the project cash flows to repay
and
the
then
debt
as a
on the
backup is going to be the cash
backup, or we'd look at the
guarantor.
as the guarantor. That individual is a guarantor.
Sam, how do you feel about signing on to $1 million loan as a personal guarantor?
Well, I wouldn't feel great about it.
Why not? If it's a good project, you ought to put your money where your mouth is.
Yeah. How often do you see this? How often do you see that kind of loans?
Meaning with a personal guarantee.
Yeah.
Primarily, every deal we do, we require a personal guarantee.
Start clutching the chest. So
As Mr. Mod knows.
do you find there's been somewhat more frisky economic activity? Is it about normal? Is it a little bit lower?
I would say in the last, with interest rates up, things have been definitely quieter. For whatever reason, in the last 2 months, we've seen an uptick in activity. People get used to rates and they get tired of sitting around for too long. Those that are in that line of work, or they get restless and they figure out a way. And then on top of it, prices to purchase something come down. And
With rising interest rates, you're saying
eventually
compress asset value.
Well, yeah, because if somebody's needing to sell and they're not getting any movement, they got to come down in price, of course.
Correct.
And so the prices come down, and then they can, even though rates are higher, they're able to make that project cash flow by the price that they're getting it for. So we're seeing a little bit of that.
So the Federal Reserve ostensibly sets the federal funds rate. And the higher they set that, obviously the higher the interest rate is. That is being sold to the American public as a way to arrest inflation. So you're saying it actually, at this point, left unchecked, would actually not only in theory eliminate inflation, but would also have the effect of deflation. Compressing asset values is deflation, correct?
Correct. But we're talking about one sector of inflation, which is
I agree.
where
But commercial real estate is that larger than personal residential property? Is it the same? Which segment of that is going to be the largest?
Well, I would say homes are going to be the large. I mean, unless you get into the goods and services, but home buying and selling is probably much bigger than anything that is out there in the financial community.
So what is a mortgage rate? Just a typical 30-year mortgage rate for
I think at 30 years, I haven't looked this up because I'm not in mortgages, but I think it's around 6 3/4 to 7%. It's a 30-year mortgage today.
So what about a good quality commercial real estate deal? What would be your effective?
We're going to be around that, anywhere from 6 3/4 to 7 1/4%.
What's the 10-year treasury rate right now?
I know the 5 years, right, because I look at the 5-year more.
Okay.
I haven't looked at the 10-year, but it's somewhere around 4.3. Am I correct there? 4.3, 4.4.
So between 4 and 4.5, and you're adding on 250 to 350 basis.
Well, on the 5-year, the 5-year is right at 3.95 or 3.94.
So if you're charging me 7%, you're adding 300 basis point spread.
We want to be somewhere between 2.75 and 3% above the 5-year treasury. It's kind of
on $1 million.
It's one
on $1 million loan, interest only. That's $70,000 a year.
That is correct.
And that at some point is going to have the effect of compressing asset values. People saying, I have to put up so much more cash. I can't get sufficient returns with my tenants to be able to justify this $1.3 million building. So at some point, for the seller to want to clear that asset off of his or her balance sheet, they have to be willing to lower that price before
Correct.
coming into line to make it work. So interest rates, going back to it, the U.S. has, and this is governmental accounting 101, basic blocking and tackling. The vernacular is in a calendar or fiscal year, depending on how the government does it, 12-month period. If you pay out more than you take in, you have a deficit. That deficit gets added to, and it's either paid off by a surplus or gets added to the debt. So the U.S. has a national debt right now. Sam, did we say about $36 trillion?
Yeah, even more than that, $36.6 trillion in debt.
Oh. So we did some research, and Sam, correct me, but we discovered that for every $1 trillion in debt reduction, not deficit, but debt reduction, it translates into about an 8 basis point reduction in effective rates measured by the broad market of all financial instruments that are interest rate sensitive. So that means to get a 1/4 point reduction in effective rates takes $3 trillion of debt reduction for the United States. So what do you think it would take to get from, let me rephrase it. What percentage of decline in effective interest rates today that you would charge or your mortgage bankers at I3 would charge might stimulate more economic activity, whether that's selling assets, whether that's, as a home buyer trying to buy assets?
A 1/2 point would be effective in getting some activity. I think to get more activity than what's out there today is how I should put it. A full point reduction, I think we need to get into the 5s, down in the 5% range for home lending, and I think that really get the steam picked
So
up.
from 7 down to 6 is 100 basis points.
Right.
That's 1%. You just said the 5. So we've got to
into the 5s.
That's
just 6% or down to that 5 3/4 to 5.875 mark. And I think then it'd be more of a sustainable rate that is going to keep activity up. What we saw for, 12, 13, 15 years with those, when we were sitting in the 4s, it's going to be a long time, I think, before we see those kind of rates again. I think the more sustainable rates are going to be between that 5 and 6, that would keep very steady flow of business coming and going.
So at 8 basis points per trillion, I'm going to just approximate, to get a 1/4 point reduction requires 3 trillion in debt reduction. You're talking about 100 basis points, so 4 times more. We got to get 12 trillion in debt reduction, 1/3 of a simplified $36 trillion debt.
But a 1/2
Correct?
point, a 1/2 point
So
would
6
go,
trillion.
yeah, a 1/2 point will go a long ways.
What was it? And this is incendiary because a lot of people did not like Elon Musk. Maybe they still don't. A lot of people don't like Donald Trump. Maybe they still don't. But Trump and Musk had the Doge organization or entity that people went absolutely batshit crazy. But ultimately, one of the things we learned is there is waste with governmental spending. There is abuse. There's clearly fraud. So what do you think would really be, if you keep everything else the same, what things do you see that would help elected officials actually be able to reduce the amount of debt this country has to get that more manageable and long-term sustainable interest rate that is kind of the perfect equilibrium between supply and demand, activity and inactivity in the U.S. economy?
Well, clearly we need to reduce government spending.
But we just saw everybody went, again, hair on fire, batshit crazy over Doge proposed cuts. And I don't recall, but I think 4.7 trillion was a number at one point that Musk was talking about earlier this year. Again, people went crazy. So that suggests there's not an appetite for people to want that. But the bigger thing is I haven't heard one of the elected politicians that have said, yeah, we want and we're going to strictly enforce spending reductions. There's lawsuits up the wazoo saying, oh, you can't get rid of this group or this group of employees, which human resources is typically going to be the highest cost for a business, especially the government. So what else do you think can get us to the point? Sam, you can chime in on this. How do we get the reduction in the debt to, again, somewhere between 6 and 12 trillion, and say it takes 3 or 4 years? There has to be an appetite. There has to be a backbone to be willing to do that. Ultimately, Americans have to get to a point of so much suffering that they finally say, we are ready to endure the pain and suffering of cutting back on some of this governmental largesse.
Well, like we were saying, we were talking yesterday how a way to get rid of inflation is more inflation.
Well, and that's I mean, that is the cure for inflation, but that's why the Fed's raising rates,
Yeah.
is to try and slow down some of the economic activity. But what else, guys?
I think if we can get rates down, we're going to increase activity, especially in the housing sector, which is,
You just said is the single largest sector of the American economy,
well, I don't know that for sure, but
involving real estate.
yeah, housing's a big part of the U.S. I mean, it just
Well,
it
housing
is, always has been.
down. I mean, people buy furnishings for their home. They buy TVs,
They buy goods,
paint, carpet,
services.
goods, services, and it's ongoing. Every house has to have maintenance. They're buying roofs. They're buying carpet. They're buying paint, like we said. So obviously it's a big deal. Back in the late 90s, I mean, as we know, Alan Greenspan and that whole group, they thought home ownership was the single greatest thing going and was going to raise people out of poverty, and did everything we could. And there were huge numbers thrown out as far as what home ownership did for the U.S. economy. Was it 2/3 of the economy is consumer and 1/3 is
Yeah, I think that's correct.
commercial? So again, at some point we have to have maximum pain for Americans to be willing, apparently, to tolerate reductions in government spending. It begs the question. I don't even get it. Whether you like Trump or Musk or Doge, when they're
Or whoever,
discovering,
but-
I mean, again, it doesn't matter who it is, when they're discovering profound waste, why would you fight against that? It makes no sense. If someone were stealing from you in your own home, presumably you would say, I'm not going to stand for that. If a contractor came in to paint your house and they upcharged you an extra $2,500 and didn't tell you, and you found out about it after the fact, you'd probably want to go after that contractor for screwing you over. So why is it okay when the government doesn't? Well, anyway, I wax rhapsodic. That's another episode. But in the meantime, we're talking about how do we get spending and maybe there's another revenue source. But for now, let's just confine it to expense reduction, spending reduction by the U.S. government.
What are your thoughts on that?
Oh, I asked you. Sam, it's on you, baby. You got to carry the episode now.
I don't know. It's a good question.
Well, you two guys are no help. So here's an easy one. I mean, everybody pays into Social Security.
Security, I knew you were
And
going
it's
to go there.
purportedly, we can't talk about, it's this political sacred cow, but it's ostensibly a pension. Except instead of going to a third party, it goes to the government. And you have a huge, massive bureaucracy. And we all know government is the least efficient form of economic activity. So when someone hits retirement, I don't care what age it is, there's a mechanism under the Internal Revenue Code called a cash balance defined benefit plan, which is a pension plan. Except that when you hit your retirement, you're guaranteed a rate of return on that investment while it's being funded both by you and your governmental employer or, organizational employer. But ultimately, when you hit retirement, you roll that thing over. We're no longer, as taxpayers, on the hook for someone outliving their actuarial life expectancy or a rate of return. Roll it into an IRA, roll it into an annuity. Then it's between the retiree and his or her insurance company, if they're doing an annuity, or their financial advisor. And we have plenty of regulations to prevent an inevitable somebody's defrauding someone or whatever. Well, they can go to jail, and there might be some negative consequences. And I sure wouldn't want it to be at my expense or my family, but it's a solution. Get rid of a huge amount of bureaucracy, take the government out of the business of managing retirement accounts. And again, right there, probably a pretty sizable reduction in what we're spending
So
between the bureaucracy as well as the ongoing financial burden of Social Security.
you're starting to have the largest population, and I'm not disagreeing with you at all. I'm just wanting. I mean, we have the largest number of baby boomers in our population that are on. They're on Social Security or going to come on Social Security.
Correct. But even that, not a big deal. You phase it in. When you started at 2025, anybody age 50 and over, you stay on the old plan. So you don't have to have 15 years to try and make up for it if you're 65. But if you're younger than age 50, we're going to this cash balance defined benefit plan. When you retire, we're rolling your accumulated balance out, and it's up to you to manage it. And again, you can go buy an annuity, and it's up to you and the insurance company. If you live shorter, maybe they make a little bit, maybe you have your spouse as a co-owner. There are ways around the proverbial what ifs. So then again, you can phase that in. What other ideas to reduce governmental spending?
So I want to go touch base on that one more minute here. So what do you think that would, how much would that reduce?
Well, you asked an idea. I didn't tell you an answer. I'm just saying, I think every governmental agency,
And I don't disagree with you on that.
scrutiny. I would go a step further on the revenue side. There's a segment of the American population says you crank the taxes on, I love Bernie Sanders, the millionaires and billionaires until Bernie became a millionaire. Now it's just the billionaires, the great scamster, Bernie Sanders. But the point being, you can't tax your way to prosperity. I think you have to actually flatten the code. We have gotten to this point where it's a race to the proverbial bottom to see how many people we can exclude from paying taxes. Everybody benefits from being an American citizen. Everybody needs to pay in if they're getting some benefit, even if it's $10 a month. At a minimum, everybody's paying $120 a year. And you can put in a monetary limit. Just say if your gross income is below 10,000, you're exempt. But from all sources, if you're 10,001 or higher, you're paying $10 a month for governmental revenue.
Just flat.
At a minimum. And I think you can graduate it. Maybe it's 5, 7, 10%, whatever, but you probably have 3 different levels, but it's 10, 15, and 25%. So you can still get the high income earners to be paying, and what's the political term? Oh, pay their fair share. That's the most diabolical term in the American political lexicon, because nobody knows what that means. And the politicians, if they're smart, they don't define it, and they just let everybody run around bidding against themselves, say, this is my fair share.
What do you think so touching base on your highest wage earners in this country? Wouldn't you say that,
wage earners, household income. So
I didn't mean wage earners. I'm talking about income earners in the United States. What would you think the percentage is? And I don't know the answer to this, but that they employ in this country.
That's a great question.
Your highest net worth individuals and your highest income.
You're on it.
And your highest income earning.
So you're talking about a multiplier effect that are you leading up to? We don't want to tax a high income earner because there is a high likelihood their organization or they themselves employ a big group. That leaves us a little bit more to unpack for our next episode.
Right. I'm just saying, though, that I really believe that think just in Lincoln, the highest net worth individuals in this town probably employ the largest number of individuals in this town.
So your concern, putting words in your mouth, is if you tax that group too heavily, they will ultimately elect to minimize their taxes by lowering their economic activity.
Well, it's going to have an impact,
which would result in layoffs, which would result in unemployment.
And I don't know if that's true or not, but it sure seems like it could be true.
Again, a lot to unpack. Let's do that on our next episode. You're coming back, right, JP?
I can come back.
Well, really appreciate you being here, Sam. Always appreciate you being here. Guys, this is for my entertainment. We all hope that you were entertained as well. And maybe on the margin, you learned a little something. In the meantime, thanks again, guys, for your time. Thanks everybody for tuning in. As Sam said at the intro, don't be afraid to say we like you, and do it on X and Instagram and YouTube and all the other stuff. Cheers, everybody.
Life matters. Thanks, guys.
Let's turn this thing off.